The living wage can be defined as the minimum hourly rate that a worker needs to earn in order to be able to fulfill their basic human needs. These human needs include shelter, clothing, and nutrition. The living wage is calculated according to the basic cost of living in the UK, and the rates are updated annually to allow for inflation. The living wage differs from the national minimum wage in that the latter is set by law, whereas the living wage is not legally enforced by the government, and therefore it is only a guideline to what employers should be paying their staff. Currently, the living wage is set at £7.45 for outside of London, with a separate rate of £8.55 for residents in the capital. A study of the benefits for businesses that have implemented a living wage policy in London found that more than 80% of employers believed that the living wage would enhance the quality of the work their staff produced, while absenteeism had fallen by approximately 25%. Two-thirds of employers also reported a significant impact on recruitment and retention within the organisation. 70% of employers felt that the living wage had increased consumer awareness of their organisation's commitment to be an ethical employer, and this helps the company increase sales. From an individual's point of view, 75% of employees reported increases in work quality as a result of receiving a living wage, as they were more motivated due to the increase in pay. It has also been reported that 45,000 people have been lifted out of poverty as a result. Also, the increased wage will mean people have more money to spend, and this is likely to lead to an increase in consumption, and therefore a rise in aggregate demand, leading to growth in the economy. This assumption is made due to the fact that low-earning individuals have a low marginal propensity to save, and a high marginal propensity to consume. This is depicted in the graph, as consumption is a function of aggregate demand. The aggregate demand curve, labelled AD, shifts outwards to AD2, causing national income to rise from Y1 to Y2. In addition, the introduction of a living wage would reduce the income gap between the rich and poor. It also forces wealthy employers to share some of the money they earn with people who help them make it. Furthermore, the government will receive extra revenue from income tax as individuals earn higher wages and therefore pay more tax. In addition, the government will reduce the number of unemployment-related benefits it has to pay, as people who are voluntarily unemployed have a greater incentive to seek work. The graph shows how, at the minimum wage rate of £6.19, a quantity depicted as Q in the graph is employed by the labour market. However, when the increase in wage takes place and wages rise to £7.45, we can see that it is possible for the number of workers to increase from Q to Q2. On the other hand, the implementation may cause unemployment to increase within the economy, as employers may not be able to afford to pay staff the increased rate, and therefore they may have to reduce the number of staff they employ. This is demonstrated on the graph, as it can be seen that after the wage increase, the number of workers can fall from Q to Q1. This will lead to an increase in the number of people claiming unemployment-related benefits, causing additional financial strain on the government. Moreover, it is possible that inflation in the economy will rise due to demand pull factors, as people consume more goods and services, causing price levels to rise. Finally, if businesses are forced to pay a higher wage, then they may seek to illegally employ people on the black market and provide work for people who are prepared to work for less than the minimum wage, in return for cash in hand. This will enable the business to avoid paying payroll-related costs, such as national insurance. To conclude, the effects that enforcing a living wage would have on unemployment depends on the elasticity of supply and demand for labour. If the elasticity of demand is inelastic, unemployment will decrease. However, if elasticity of demand is elastic, unemployment will increase, and the government may prefer not to introduce the living wage. Likewise, if elasticity of supply for labour is inelastic, unemployment will increase. But if elasticity of supply is elastic, then unemployment will decrease. Nevertheless, levels of unemployment will not be the sole concern for the government, and the observed increase in productivity will lead to higher national output, causing real GDP to increase and the economy to grow. For this reason, I would recommend the government enforces a living wage as the country's minimum wage, as the increase in productivity may lead to more jobs becoming available and unemployment being reduced further.